In this video, we want to talk about the funds that can be used to track the various asset buckets. To get to this page, just simply click on the More button and click on Asset Buckets. At the bottom of this page, we list all the various asset classes that we track. We also list the Consumer Price Index, which is not an asset class, but we wanted to show where we found the data for the Consumer Price Index for following inflation. You can highlight, you can't click on these links directly, but you can highlight them and copy and paste if you want to go look at the data yourself. We show the year in which the data was established. We also show dividend adjustments. Some of this data did not include dividends, so we had to add in a hard-coded value to make up for that, and we did that for the NASDAQ and the Dow Jones. Now this is all great for historical analysis. However, if you now want to purchase a security or a fund or whatever to track this data going forward, that's what this fund column is about. These are all ETFs or exchange traded funds. In some cases we list one fund, in other cases we list two, so you could split your allocation across those two or use one or the other. The management percent here is the rough management cost to purchase these exchange traded funds. Okay, so that's what you would use going forward. So now when we click on the variable annuity calculator and go to generate an annuity table by clicking on compute annuity table, you now have your annuity table that lays out your asset allocations. You could go ahead and do your historical analysis to see how that's performed over history. However, what you really want to know is what funds do you need to purchase to track those asset classes. And so what we've done to give you confidence that those ETFs that we've identified to track your asset classes is we did a little study over recent history and did some actual trades of those ETFs to see how the DoubleBucket method will work. And you'll find that study on Live Performance. You'll probably want to read through this text here to get some background on the study. At the bottom of the page, we list the specific ETFs that were used to mimic the trades in the study. Also, we list what we thought was interesting performance item here. The period from May of 2008 from February to 2009 was the period of the Great Recession where the stock market and real estate really crashed. And you can see how each one of these asset classes did during that 9-month period. And stock performance was way down. Real estate was even worse at negative 62%. Some saving grace was gold, and 10-year bonds. Cash didn't do too bad either. So anyways, no matter what plan you're probably using at that time, it would have suffered. So we thought that was interesting to note. Now, the study did a couple different things. First off, I'm going to go to the second of these two, trades and rebalancing. What we show here is, this is the starting point. The DoubleBucket method told us that we could take out 4,700 according to that annuity table. And then this is the remaining balance. The way this works is we take this just out of cash. And then every 6 months, we're going to rebalance. You could do your rebalancing every monthly if you wanted to, but probably be more reasonable to do it quarterly, every 6 months, or maybe even every year. So we can see here that we're taking money out of our principal, but the market did pretty good, and it kept above water a little bit. We started with $1 million, and at the end of the 6 months, we were still above $1 million. Now, because we're taking this out of cash, that's why we needed to buy more cash at the end of the 6 months to even everything out. These other funds, minimal amounts were needed to either buy or sell to even things out. However, real estate must have done really well because we ended up selling real estate at the end to average everything out. So anyways, this shows you going through from 2005 onward as far as how the actual trades panned out every 6 months and your withdrawal. Um, Everything did pretty well, but then in 2008, when the recession kicked in, notice that from one month to the next, it went from 5,500 all the way down to 41.6. Certainly isn't ideal, but you need to make those adjustments in real time in order to make your money last through the end of retirement. Eventually, things started recovering and the withdrawals went up again after the market recovered. All right, so that gives you a feel for the trading history. We took this all the way out to the end of 2020. The other report shows a comparison against the 4% rule. And here we show what you would withdraw with the 4% rule and what you would withdraw from the double bucket. Now, if you go down to that one period where things really dropped with the double bucket in January of 2009, the reason it kicked in there instead of earlier is because we don't readjust. We only readjust every year. When you do real trades, you'll adjust more often, and it won't be that you won't wait that long to do the adjustment. So the double bucket in at the first part of 2009 was withdrawing 4,100, 4% rule is 3,800. So we still kept above the 4% rule. And then going out further, you can see the double bucket does quite a bit better than the 4% rule. Okay, so that's the studies we've done now. And the purpose of that is to give you a feel that you can really use those ETFs to mimic our historical analysis. Now, we do admit that those time studies were rather short. They only went back to 2005. The reason we couldn't go back any further is because these ETFs didn't exist before that time. Okay, so that concludes the demo. At this point in time, we encourage you to go out to the website and experiment with a calculator for your own situation. Thank you for watching.